This is Business Breakdowns, powered by Microcap Club, a series of deep dive conversations with microcap companies and the investors that know them best. Our goal is to explore the inner workings of microcap businesses while giving our community direct access to compelling companies and their leadership. I'm Ian Castle, founder of Microcap Club. Microcap Club is a private community of the world's best stock pickers. Since 2011, our members have profiled 1,500 companies, and over 300 have turned into multi-baggers. That's at least one big winner every month for 14 years. If you enjoy finding great companies early, well before Wall Street pays attention, Microcap Club is where you belong. I hope to see you in our community. And now a quick disclaimer. The purpose of this presentation is for informational and educational purposes only and should not be construed as a recommendation to purchase or sell any security. Microcap Club is not a registered investment advisor. Microcap Club, its partners, members, subscribers, guests, and affiliates may or may not hold positions in one or more of the securities mentioned on this program and may trade in such securities at any time. Do your own due diligence and seek counsel from a registered investment advisor before trading in any security.
All right. Welcome, everybody, to our business breakdowns with BeWhere Holdings. I want to thank the Microcap Club community for tuning into this business breakdowns conversations with BeWhere CEO Owen Moore. Owen, welcome. Thanks for joining us today.
Hi, Adam. Thanks for having me. Happy holidays.
Thank you. Same to you. My tag team partner for this business breakdowns is Trevor Treweek. Trevor has been a Microcap Club member since 2015. Trevor, thanks for joining us as well.
Hi, everyone. Thanks, Adam.
The business we are breaking down today is BeWhere Holdings, which trades on the TSX Venture Exchange under the ticker BEW and over the counter under the ticker BEWFF. BeWhere was originally profiled in 2016 by Sujan Lahiri. BeWhere Holdings is a mobile Internet of Things industrial IoT company that designs, manufactures, and sells hardware with sensors plus software to enable real-time tracking and monitoring of non-powered assets as well as environmental sensing. End markets include a wide set of industries with need for remote or distributed asset and inventory management, notably logistics, transportation, and fleet operations. Also construction, heavy equipment, government, and public services. Before we get into the presentation today, Owen, I'd just love to hear about the inception of BeWhere, what brought you to the business, and maybe how you see things shaping up in the near term.
Perfect. Thanks, Adam. I appreciate it. So I have a long history in wireless technology, specifically vehicle telematics, prior to starting BeWhere. So what we like about the industry is it's typical SaaS model, high recurring revenues. The reason we pivoted out of vehicle tracking into asset tracking is because it was a market that's much larger. I mean, the vehicle tracking market is capped by the number of commercial vehicles for companies who focus on the commercial vehicle space. But if you look at the TAM for asset tracking, it's an absolutely massive market. And every time price points come lower in our market, the TAM increases. So that's what drew it to us, was really the market opportunity and the opportunity to leverage new wireless technology to bring products to market at a price point that hadn't been seen before. So really for us, we saw an opportunity to disrupt an existing market, but also that existing market was growing as price points reduce. So that was the logic behind it, Adam.
All right, excellent. Lots of good stuff to pull on there in the webinar. So with that, I will hand over the presentation the mic to Owen to go through the company presentation. As a reminder, listeners can ask questions by clicking on the Q&A box at the bottom of the screen. Owen, the floor is yours.
Thank you. We'll dispense with the safe harbor. So as I mentioned, our goal is to disrupt the asset tracking market by providing all the features, functionality, framework, stability, reliability of existing asset tracking products, but at a fraction of the price. The way we do that is by, one, our business model is lean. We don't sell directly to end users other than a handful that I'll touch on as we get through the deck. But primarily we sell through distribution. So our clients include the likes of AT&T, T-Mobile, Bell Canada, who's also an investor in the company, as well as a large number of technology partners. That allows us to keep our overhead low. We don't invest a lot in sales and marketing, but we do give up margin on our product to leverage large sales and marketing teams of the likes of the companies that I just mentioned. So that's essentially what we do and how we do it, and we'll jump right into the presentation. So it's devices. We design and manufacture hardware. We create our websites. We write the middleware, the firmware for the device. So our emphasis is on the technology and then leveraging strong partnerships to bring the products to market. Really quickly at a glance, annually over the last 6 years or so, we've been growing at about 30%. We've sold, as of today, over 500,000 devices. About 325 to 350,000 of those devices are generating recurring revenue for us, and we keep a very lean overhead. Only 22 people generating, well, as of last quarter, annualized at $24+ million in revenue. It's a SaaS model, and in some cases, it's a half SaaS model, so hardware can be bundled as a part of the service. Insider ownership is about 22%, but that doesn't include Bell Canada, who owns about 6% of the company, and then employees and other inside, not technically not insiders, but with employees in Bell Canada, we're looking at about 30% of the stock. We've been positive EBITDA since COVID, since 2020. We haven't raised any money since 2019. We just grew our balance sheet organically by generating operating cash over that time. Really quickly, I'll just try and minimize this a little bit so you can see the full screen. Q3 at a glance, basically metrics were up across the board. Revenue was up 21%, recurring revenue was up 20%. I believe it's our 24th consecutive quarter of positive EBITDA. Annual recurring revenue sits at about 8.6%. So if you take our current quarter and annualize that, you're looking at about 8.6 million in revenue. That's up 21% year over year. And the stat on here that I'm most proud of is that the margin on our recurring revenue covers 99% of our cash expenses as of Q3. So going into any quarter, as long as we can continue to grow that recurring revenue and continue to manage our cash operating expenses, strong likelihood of EBITDA going forward. When you have your recurring revenue covering your operating expenses, or at least your cash operating expenses, you get good visibility into earnings going forward. Working capital was also up in the quarter. It went from about 7.2 million to over 8 million in working capital. Pardon me, that's not in the quarter, that's in the year over year. So we're addressing very large markets. The type of assets that we track include everything from dry van trailers to flatbed trailers, boxes, returnable pallets, construction equipment. We are in the bike share industry. We work with Lyft to provide bicycle tracking for their ride share bikes. It's not just tracking though. Every one of our projects has an anti-theft or a loss prevention component to it, but there's also an ROI that you need to be providing to your clients. So in the case of bike shares, just as an example, they do get lost, they do get stolen. So that's clearly one of the components to the system. But specifically in the case of the bikes, we integrate to the bicycle computer unit. We actually use our B Mini product, which is this product right here. It's about the size of the box of Tic Tacs, but it's just loaded with technology. It has low power 5G, Bluetooth, Wi-Fi. It has a computer interface to communicate directly with the bicycle's computer to monitor things like battery level and whether the lights are operating. And so once again, a theft or an anti-theft or a loss prevention component combined with an ROI seems to do the trick for us. As we continue to drive the price points down on our products, as I mentioned in the introduction, it opens up the TAM. It opens up the market opportunity. And so, today we're tracking assets that cost well under $1,000. Because the price of the hardware and the monthly services have come down, it makes it viable to track those types of assets. And one example of that are portable toilets. We've been tracking portable toilets for one client for the last 4 or 5 years. And while you might not think portable toilets get stolen, they do get stolen. Competition comes in many forms. But again, it's not just making sure the porta potties aren't getting stolen. It's understanding whether they're at a client site to drive the billing system so that the portable toilet providers can have accurate billing and have backup for that billing they charge to their clients. But it also helps their logistics team. So when they're picking up some of the portable toilets on a construction site, they drive right to the porta potty to get it. They don't have to drive around a big construction site looking for a specific asset to be returned. So the trailer and cargo tracking has obviously been a mainstay for us. That's a subset of the IoT sensor market. It's projected to grow to about $7 billion in revenues by 2032. The other segment that we operate in is obviously asset tracking, which includes more than trailers and cargoes. And that's an industry that's expected to grow at about 12% going into 2032 and going from 26 billion to over $60 billion market. So very large markets, lots of opportunity, and you really only need to get a relatively small portion of that market to do substantially well. Excuse me. So we have 4 main products in the market and a fifth one coming very shortly. This is our BSOL device, our BSOL Plus, our latest iteration. It has a solar panel and energy harvest. It has an industry-leading reporting rate of about 5 minutes reporting just based off cellular charging and a rechargeable battery while the asset is in motion. We have a battery-powered device. This one's called our B10, or our B10 Plus, I should say, our latest iteration of it. The 10 stands for 10 years. So this small device can operate for 10 years off of 2 disposable batteries. And that's some of the power of these new low-power cellular technologies that we leverage. Their price points are lower, their power consumption is lower, and it allows you to create a device that can last for many years in the field for a relatively cheap price. And this is an example of that. 10 years off. Now, there is a caveat to it. It'll operate for 10 years off 2 AA batteries, but that's reporting once a day. If you report twice a day, you get about 5 years and so on and so forth. The other devices are rechargeable either through the solar panel. This is our BeWire device, so it has the ability to take inputs and an external power source to charge its battery as needed. That's a chart of our cumulative growth on the right side of device sales over the last 6-7 years or so, and that trend continues to go up. We are about to launch a new product, and keeping with the theme of high functionality, reliability, but dropping the price points. This is our BeBatt. We were actually going to call it the Batman, but I think that would get us in trouble with some trademarks. So it's officially named the BeBatt. It is a purpose-built product. I'll actually just jump ahead in the deck just to show you specifically what it's built for. Just bear with me. There we go. It's actually built specifically to track these cable reels. These are cable reels that you'll see on construction sites or as new infrastructure is being built out. It handles, power primarily and communications. But these are large reels that are primarily copper, so there is an intrinsic value to them. So once again, anti-theft is important. And, as I mentioned before, you always need an ROI. So this particular device goes right in the center of that wooden reel on the right side in the picture, and it measures the rotations. It measures the rotations both clockwise and counterclockwise. and the clients and end users can use that information to get an indication of how much inventory is left on the reel. So that if they are running short on a job site, they can bring in new inventory. Often our clients manage by exception, and they'll get a report letting them know that they're running low and get more product out there before the job site comes to a halt. We actually started in the steel cable reel industries. This one over on the left, using our B10 device, and as the opportunities continue to expand in that industry, we've created a purpose-fit device for the wooden reels, which is a much larger market than the steel wheels. So we're excited about that. This is coming out imminently, like within the next couple of weeks for clients. And once again, we engineered the cost out of it. So we got the price point down about 30% from our B10 product, which it's essentially going to replace. And so we're going to be bringing it to market at a lower price point, but we make higher margin off of it. And so this is an example where, parasitizing your own products can be a good thing, especially if you're making higher margin, both the dollar value as well as the percent margin. And so we're excited about the launch of that. And then coming in the next couple of quarters, we'll be upgrading the other products. Once again, engineering cost out of the product to make it even more competitive and more disruptive in the marketplace. I'll just come back to where I was at. Okay. One of the things we pride ourselves on is always adopting the latest in wireless technology before it becomes available to the consumer market. An example of that is an announcement that we made around the first week of November, I believe, with a company called AST Space Mobile. I'm just getting a warning about my internet connection. I hope it's okay and you can hear me. But this is a super cool project. A lot of people for the last several months, going back even a year, have heard about being able to get satellite text messaging to your Apple phone or your Android phone. This is an industry that's evolving very quickly. There is some stiff competition, the likes of SpaceX. Amazon has their own satellite communication birds going up into the sky, but AST Space Mobile is a unique one. They offer broadband, mobile broadband to any existing 4G or 5G device in the market. And so while there's not a lot for us to do from a hardware perspective, we do have to write firmware to manage the handover between cellular and satellite communications. But the real interesting thing about this technology is that it works off of our same cellular module that we have in our products that we've been rolling out for the last couple of years. And so, traditionally satellite asset tracking has been an expensive endeavor for clients. You've been looking at $500+ US per device, anywhere from $5 to $10 just for the satellite data alone. The real unique thing with AST Space Mobile is that this leverages our existing cellular modems with nothing special done to it. So, you're talking about cellular modules that cost $10, devices that are sub $50 BOM cost. Being able to address a market that traditionally has been, a lot more expensive. And once again, anytime you have that price disruption, it opens up the market opportunity. It opens up the TAM. For us, it's super strategic for us to focus on AST Space Mobile rather than Elon Musk's network or Amazon's network, because our distribution partners, and in the case of Bell, a shareholder as well, have invested heavily in AST, not just equity investments. Bell, AT&T, Verizon, Vodafone have all made fairly substantial equity investments into AST, but they've also put the effort behind lighting up the service, so they have operational investment in it as well. So, for us to continue alignment with our mobile network operator partners, it was important for us to leverage AST. And what we showed with the tests that we announced, and this was the first IoT device to successfully connect on AST's network, was that it will work with low power 5G, and low power 5G has a different antenna architecture than what you would see in your smartphone. Smartphones have a technology called MIMO, multi-input, multi-output. Low power 5G has a single antenna, which makes it, a lot less expensive. But some would argue that you don't get the reception that you would get out of a MIMO type architecture. And so there could have been some concerns that low power 5G wouldn't work on AST, but it just worked perfectly. And one of the reasons AST is such an interesting opportunity is those satellites, when they roll out that antenna in the sky, it takes up about the size of a tennis court. The competition, Starlink, has an antenna that's about, a meter long. And so, AST only needs to get about 60, 70 satellites in the sky to have full coverage around the world and the ability to handle the communications and the reception and transmission. Whereas Starlink is putting up literally tens of thousands of satellites to cover the same, Earth. So kind of an interesting proposition. This also aligns with our strategy with AT&T, where we work with their FirstNet clients. FirstNet is a technology that provides prioritized service, cellular service for first responders. We have devices that are FirstNet certified. AT&T will be selling FirstNet clients. AT&T will be selling AST's technology to FirstNet clients. And we're already in the FirstNet channel, and this will provide more expansion opportunity for us. Here in Canada, it's really about getting after industries that are outside of the traditional cellular coverage. So we're talking about mining, resources, agriculture, ocean-going freight, fisheries, those types of industries. So two different approaches in Canada versus the US, but we're excited about both of them, obviously. So I mentioned we sell through distribution. I talked a little bit about the mobile network operators. There are a number of technology providers, including vehicle telematics partners of ours that, they leverage our devices for asset tracking. They use their devices for the vehicle tracking portion of the business. That allows us to get access to very large clients, and you can see some of the end users that have been brought to us by our distributors, the likes of Walmart, Home Depot, Lowe's, Boeing, Toyota, PG&E, the list goes on. But there are just a handful, and literally a handful, about 6 clients that we take on directly. That includes Costco, UPS, Purelator, Brinks, and I'll talk a little bit more about those. But there's reasons why we'll take some on directly, and that's primarily because with an indirect distribution model, you don't get a lot of interaction with the clients. Our distributors get interaction with them, but we don't. So when we take on certain clients direct, it's because we want to have that close relationship to understand their pain points, to understand their ROI, and they're typically clients that have a very large opportunity with them. Here's an example of the large opportunity. Over the last sort of 3 to 6 years, we brought on 5 Fortune 500 clients: UPS, Costco, Lyft, PG&E, and Lowe's. Where it gets interesting is if you just look at over the last year and a half, we brought on 5 new enterprise clients that if we can perform as we have historically with the large enterprise clients, we're expecting big things to come from them. And if you break into these projects a little bit deeper, it's a compelling opportunity. So I'm going to actually jump back to the case studies a little bit and specifically talk about UPS. Often we call it land and expand. So for us, it's important to get our foot in the door and get that initial contract, prove ourselves out, grow the opportunity within that specific project, but also look for opportunities within those clients where we can sell more devices into and work with other departments. And UPS is a prime example of that. We started with their automotive division, and then we got introduced to their peak season team. Their peak season team brings in a lot of tools and equipment to manage devices through Q4, Q1. You're looking at the holiday rush as well as the the Boxing Day rush, and they wanted to understand whether that equipment is being used effectively, or if they're ordering too much, if they're ordering too little, just to optimize their operations. And so that's just a prime example of getting a foot in with one opportunity and trying to grow it, over time with other opportunities within that same client base. Of these clients, I think on the left side of the new one, I think Ford is the one that we're going to see take off the soonest. And I'll just share with you really briefly some of the work we're doing with Ford. So this is Ford Pro's website. Ford Pro is the fleet division within Ford, and they sell their own telematics solution. Obviously, Ford is installing modems in cars. They've been doing that for years. They have access to all the in-vehicle sensors to populate a strong telematics platform that they provide. But like a lot of telematics companies, they don't focus on assets, but they have a requirement from their clients to track the assets that are outside of the vehicles. And so we lit up, we started the process about a year ago, maybe a little bit over a year ago. And then just at the end of September, beginning of October, they went live with the system. So they're selling our devices through Ford Pro dealers throughout the US. Canada's next, and then Europe is a few months down the road. But they do a great job of marketing the product, and you're welcome to go to Ford Pro's website to look at their asset tracking solution that they provide. It is white labeled, so you won't see our name on the devices, but obviously from the devices I just shared with you, it's our devices. So we're expecting good things to come out of Ford. They're currently ahead of schedule and ahead of their forecast, and more opportunities coming, not just with end users that Ford sells their trucks to, but also internally at Ford. There's opportunities coming up that we're super excited about. I'll jump back to the deck here now. Okay. One thing that in our industry, and it's been happening for a while, is moving your revenue model to drive recurring higher by bundling in the hardware as part of the monthly fee. This is something that has been done in the cell phone industry for a while. Nobody pays, or few people pay for a phone outright. You just pay for it monthly, and we're seeing that demand from our clients, and we like that. We have the balance sheet to support it. That's where we've been allocating some of our capital to over the last year, is supporting a model that will ultimately increase recurring revenue for us in the future. Like a lot of companies that rely heavily on the US market, we've had to deal with tariffs. We're in a very good spot now. We are USMCA compliant, which allows us to ship product into the US at 0% tariff. We don't think that's going to stay that way for very long. And as a result, we've lit up secondary contract manufacturing in Albania. Primarily, we chose Albania because they met the same price points that we were getting historically, and that they don't have a lot of exposure to U.S. tariffs. And they have, they're currently getting a tariff at 10%. So if Canada, when USMCA gets renegotiated, is higher than 10%, we can ship direct to our U.S. facilities from Albania and mitigate tariffs down to 10%. Typically, we share the tariffs with our clients, so 5% to us, 5% to our clients, and that's something that we see as manageable if and when that time comes. If you break down our financial performance, recurring revenue back in 2021 represented about 1/3. Today, it's getting closer to 40% of our total revenue. I talked a little bit earlier about the growth in sales and the growth in recurring. That trend is continuing. And then, that flows down to EBITDA and gross profit as well. If you break down our numbers quarterly, as I mentioned, Q3 was a record across a number of metrics for us. came in over 6 million in revenue. One thing you are seeing in our financial statements, and this is specifically related to that peak season project, we're asking people to look at our recurring revenue on an annualized or a year-over-year basis, simply because that peak season team lights units up in Q4 and Q1. They go dormant for Q2 and Q3, and then come back in Q4 and Q1 next year. So we do have a little bit of seasonality in our recurring revenue. The last highlight of the quarter was EBITDA was over 800,000. That included a residual tariff impact of about 200,000 hit. If that tariff wasn't in place, we would have been a little bit over $1 million in EBITDA for the quarter. And we do see strong EBITDA growth going forward as well. So in the near term, land and expand with those Enterprise 500 clients. Midterm, we're looking to augment our commercial terms with including the hardware in the monthly fees. Long term, we do look at strategic acquisitions that help us resolve a problem. We bought an installation and shipping and logistics company in Pennsylvania specifically to help us with the tariff issue so that we could import efficiently into the US to our own facilities. Another major initiative for us is growth outside of North America. And so we do have plans to get into the European market and invest in lighting up clients there. A very strong management team, people that have been in the industry for well over 20 years that I've had the opportunity to work with throughout my career. Margot is the only relatively newcomer, but even she has a ton of experience now in telematics. Alvin, I think, is one of the best chief technology officers, one of the best technologists in the telematics and asset tracking space. I've worked with him for over 25 years. Same with Chris and Brian and Rajiv, long history with these folks. Really quickly, I'll just try and summarize it, move to a cap slide, and then hopefully we can get to some Q&A. I hope I haven't taken up too much time. So we're in a market that's growing rapidly, and we're showing growth that's higher than what the market is expected to grow at. So that feels like we're doing something right. We have a strong financial position, strong balance sheet. Working capital continues to expand. And we're doing all of this just through organic free cash flow generation. On the capital structure, and this is a little bit old. It's about a week old, and the market could have fluctuated. But sitting with an enterprise value of somewhere between 65 and 70 million, the stock is traded anywhere between 60 cents and a buck. Shares outstanding 89 million. No warrants outstanding. Right, we haven't done a financing, and any warrants that had expired long ago. The options are all in the hands of directors, employees, and executives. And last point, as I've already mentioned, is strong insider ownership. So with that, Adam, if there's any questions, I hope I didn't go too long.
Excellent. Thanks, Owen. That was great. Really comprehensive and a lot of interesting things to dig into there. As a reminder, if you have a question, you can ask it by clicking on the Q&A box at the bottom of the screen. So I will kick things off with Q&A, and I'm interested in understanding a little bit more about something you mentioned early in the presentation about taking a margin hit on equipment to boost sales and marketing efforts. Did I hear that correctly? And can you just add some color there?
No, I think, yeah, that might not have come across too clear. Essentially, if you have a distribution model where you're selling indirect, and at the same time you're trying to disrupt the market from a price point, we need to provide the devices to our distributors at a price point that allows them to mark it up and continue to be under the competition, under the competitors that are selling directly to the market. So it's not as if it's a strategy going forward, we're going to be reducing margins to make more room for our distributors. It's been our strategy from the beginning that we have to sell them a product at a price point that allows them to mark it up and still be under the price points of the competition. So what I was saying is essentially we give up margin on our product in return for access to those distribution channels. And it's always been that way. It's not a new initiative for us.
Okay, thanks. That makes sense. And then in terms of your larger customers, how do you see the increase in use cases unfolding with them moving forward? Like what has to happen for that scenario to materialize?
Yeah. It's interesting when you go through a process to be awarded business with these types of clients. It's typically an RFP. That RFP involves everything from IT security to an analysis on the devices, their reliability, their function. So it's an all-encompassing process. Once you're able to get through that process with a client, it's a lot easier for other departments to tack on to that original procurement than it is for them to start a new procurement. So as long as you're performing for that client, when other opportunities arise internally, they look to see what they have under their existing procurement strategy, and that has worked well for us. Another example of it is what the work we've done with Costco. I mean, we track over 10,000 Costco-owned trailers in the U.S. and Canada. That's their entire owned fleet of trailers. But that doesn't include all the transportation. They use third-party logistics, and specifically, they bring in containers. And they needed to manage the containers. I mean, Costco has grown so quickly. If you look at their share price over the last 5 years since COVID, they've just been blowing the doors off of it, literally blowing the doors off of it. They have no more room in their warehouses to store product. So now what they do is a container comes in, they slap our B Mini on the container that has a bracket on it. They scan the QR code on the Mini, they scan the bill of lading. That marries the inventory information, what product is in the container, with the asset tracker, and then it tracks it right to their location in the yard. So when they need to pick, the Weber barbecues to get out to the point of sale, they can just come right to our system, type in a freeform search for Weber barbecues, and we'll show them all the containers on site where those barbecues are located. They can pick and route the driver directly to it, providing optimizations, and get that product out to the point of sale. And so, as they grew so quickly, they grew out of their warehouses and they didn't have an inventory system outside of the warehouse. And so, with that success that we had with them on the trailer side, on the transportation side, it brought us a new opportunity on the container side. And now when those containers are empty and being pulled out of the warehouse, they take the Mini off, put it back on the charging station, and wait for the next trailer to come in. So, that's an example of how we kind of land and expand. We get in with one opportunity, we prove ourselves out, and then when there's other opportunities, we hope they're thinking of us to give us a shot at it. There's a new project going on with Costco right now after, the two initial ones where they need some pallet tracking done. And they needed the software. They actually have RFID and RFID gateways on the pallets. They needed a partner to light up the software, to integrate to the APIs and put it in a common platform. And so they brought that one to us as well. So it's just an example of, if you do well, you work hard for your clients, you take a good, honest approach to them, you can get a lot more out of them than your initial project. And it always makes us feel good when they come to us because it feels like we're doing something right by them.
Okay, great. That's helpful. I'll ask one more and then I'll pass it along to Trevor. On that penetration rate data point that you pulled up, the 17%, what do you think the ceiling is there over time?
I believe that's this one here. That's 17% within the ones on the right that we've already penetrated. So, the ones on the left, you're looking at a fraction of a percentage in penetration. The ones on the right, it represents 325,000 units. So, if we can continue to perform and continue to get new opportunities with them, You're looking at probably well over 1 million assets that are, the market potential within these specific Fortune 500 clients.
Okay, great. Yeah, and I thank you very much. I will pass it along to Trevor, and Trevor, the floor is yours.
Awesome. Thanks, Owen. Thanks, Adam. Owen, you talked a little bit about the leasing model very briefly. Can we sort of unpack that a little bit? It's relatively new for the company, but can you tell us a little bit more about how that changes the economics, with inside the business? Like what do the returns look like, bundling and adding leasing to the business?
Okay, so the devil's in the details here, Trevor, and so I do need to unpack it a little bit to tell you exactly what we've been doing. Our original model, you sell the hardware, you realize the revenue on the hardware, and then every unit that goes out the door has a recurring revenue component to it, and then you realize that recurring revenue monthly. The first initiative we did was to sign a couple of our resellers up on a financing arrangement. And so it's just like when you finance a car, the ownership is transferred to the person who has borrowed the money to pay for it. That money is paid back over a term. In our case, it's 3 or 5 years. But because it's a financing and there's a transfer of ownership under that model, we do get to realize the hardware up front and then realize the monthlies out over that 3 to 5 year term. If they cancel, they have to pay out the remaining portions of the hardware. So that specific financing model doesn't drive recurring revenue any different than how we're doing today, other than it helps us increase sales. There's some clients that don't have capital budget, and this meets the requirement to push everything under an operational budget. The model that we have initiated just within the last 6 months is a rental model, and that does have the impact of driving recurring revenue faster on a ARPU basis, on an average revenue per unit, because in that model you are taking the hardware and the monthly fee, you're bundling it all into one plan, and the client has the ability to return the equipment. But as long as they keep that equipment on, you're looking at almost twice the ARPU, almost twice the lifetime value of the contract over a 6 to 8 year term by having everything under a rental model. So the way we've been funding this is just with our balance sheet. I mentioned we grew our balance sheet organically, and then we thought this was a good way to allocate capital to help us not only improve our ARPU and our recurring revenue going forward, but also to help clients who don't have capital budget to procure a system quickly and easily. So it's a long way of saying there's 3 models that we're actively doing right now. 1, they pay for the hardware up front. 2, they finance the hardware. We transfer ownership of it. We realize that hardware up front, and you will see a long-term receivable show up in our financial statements that is accounting for that. And then 3, a true rental model that stuffs all the money into recurring revenue and really improves the lifetime value of the contract going forward. So, like I said, the devil's in the details, and it's really dictated by the clauses you have in your contracts that you sign with your end users.
Got it. Thanks, Owen. So just staying on the leasing or these new models here, obviously there's a cost to this transition, or there's working capital requirements. Like, so I guess, do you guys have the adequate cash? I know you've taken a sort of a strategic approach to do it in a staged manner, but just tell us a little bit more how much capital that's going to require and how long to effectively fully deploy.
Yeah, perfect. So the payback is about 16 months, Trevor, and it changes a little bit depending on the number, the quantity that clients have ordered and the product mix that they're ordering from. So, to be able to leverage our balance sheet to do this without wiping out our balance sheet, we put a cap on it. We put a cap of 8,000 units a quarter that we will put out under this program. We've been doing it since January, so We're coming up on our 1-year anniversary in the next 2 to 3 quarters. Because we put a cap on it, the model generates free cash flow on its own, and that free cash flow can be reinvested back into the model to allow us to increase that cap. So we certainly have a mechanism to get through it, just using our balance sheet without the need for outside funds. And we're going to continue to do that. So, in the next 2 to 3 quarters, we're expecting this model to generate free cash flow rather than use free cash flow as it has done for the last year. And that'll allow us to increase that cap that we put on it and continue to increase that cap as the model continues to generate free cash flow. So that's what we're looking at, about a 6-month payback on a 3-year contract. So 36-month contract, the equipment's paid in 16 months, and then we have 20 months of good, strong cash flow coming from it.
Got it. Thanks, Owen. Switching gears here over to the satellite side of things with AST. Obviously super exciting, but are your current customers asking for satellite connectivity today? Walk us through how long you think it's really going to start to make some tangible sales from the satellite connectivity side.
Yeah, if you look at the satellite asset tracking market, so the guys that have focused on satellite communications only, and there is a market of companies that do asset tracking using only satellite communications, they always focus on opportunities outside of cellular coverage. So for us, it's been a market that we just haven't chased. We haven't had a device that works over satellite that can work in the far north or can work, when there's a disaster and cell sites are getting wiped out. And that's really what you're seeing with AT&T and Bell. AT&T is going after first responders, specifically first responders that might be dealing with disasters. And in those situations, cell sites can get knocked out, generators can get knocked out, and AST provides them that backup communication regardless of whether the cell site, the cellular network operator is actually functioning or not. So, have we played in this market in the past? No, we haven't had the opportunity. It's somewhere between $6 or $7 and $12 billion, just the satellite asset tracking market as it sits today. We know as the price points get reduced, the TAM goes up, right? The market opportunity increases. And so we are going to see major disruption in the typical satellite asset tracking space. Any satellite communication is in for major disruption, whether it's asset tracking or cell phones or messaging. If you're in satellite communications today, look out for this stuff coming down the pipe because it is going to wipe your business out if you're not quick to evolve. But for us, it just opens up the satellite market that we haven't played in the past. So it's not like our clients have been clamoring for it because we've been addressing clients that are within, cellular coverage. We haven't had the opportunity to go outside of that. And so that's the exciting thing here, going after industries in Canada, such as mining, resources, ocean-going freight, fisheries, industries that we haven't been able to penetrate in the past. And then in the US, it completely aligns with all the work we've done with AT&T and FirstNet. They're selling our devices into first responders. We made an announcement in the summer, an 8,000 unit deal with AT&T for FirstNet connected devices. And so this just increases the offering, increases the functionality, keeps the price points the same on the devices. And there is a bit of an uptick on communications because you do have satellite comms happening now, but from the device perspective, it's super disruptive, right? To have devices that you're selling for $50 that do both satellite and cellular communications, that's unheard of in the past. That just hasn't been an opportunity. And that's the exciting thing about what's going on with not just AST, right? SpaceX is doing it, or Starlink and Amazon as well. We like AST's chances though. The carriers are behind them. They've invested big in them. The carriers are obviously hedging themselves with this as well, right? If satellite communications is coming, and satellites have the ability to cover the world with 60 birds in the sky rather than tens of thousands of cell sites, It's a pretty compelling opportunity, and they're looking to the future. They want a stake in this new type of technology that can be quite disruptive. So we're excited about it. We're probably looking at another. Well, their plans are to fill out a constellation of satellites over the next 12 months or so, and then watch the service become commercial. But our ability to work with our carriers to get access to technology before it's commercial is key for us to be a first mover. So it's those relationships with the carriers that get us access to all the technology that allows us to create product and have it ready to go as soon as they start commercializing those technologies. And AST is another example. We did the same thing with low power 5G back in 2018, 2019. We got access to the technology through AT&T and Bell, and we were there ready to deploy it as soon as they went commercial with the service. So that's a key strategy for us, is always try and be ahead of the curve by partnering with our mobile network operators on technology.
Super. Thanks, Owen. Just thinking about sort of the competitive landscape right now for you guys, like who do you mostly compete against? And I guess, the hardware is, getting commoditized and you're trying to drive price lower. So really what makes BeWhere unique in its offering or solution?
Okay. So, if we look at when you talk about competitors, excuse me, I got something in my throat. The first one everybody brings up is Samsara, just because they've been such a darling in the stock market. Samsara's main focus is vehicle telematics and cameras. They don't do so strong in the asset tracking space. So, while it's a kind of a competitor that everybody is aware of, we don't really see them on a day-to-day basis in the marketplace. The companies we do see on a day-to-day basis includes a company called Orbcomm out of the States. They were public. They got bought out by private equity. They're probably the biggest in the trailer tracking industry. I believe they're well over $1 billion in sales. Once again, we compete based on meeting or exceeding their functionality and reliability at a much lower price point. And what they try and do to counter that is say, BeWhere is a relatively small company, and they try and instill fear, uncertainty, and doubt into the client base as they're making their decision. We're able to mitigate that though, because it's not us walking into the client site. It's AT&T going in or T-Mobile going in. And when you have, that type of company representing you, it takes away some of that FUD, the fear, uncertainty, and doubt. Other competitors include Digital Matters. They're not the size of an Orbcomm. They are strong in Europe and Australia and New Zealand, where they operate out of. We don't see them as much in North America, but we are, they have initiatives to try and grow in North America. We have initiatives to grow in Europe, and we will come across them more and more. But a private company, so not a lot of financial information on them out there. Historically, CalAmp was a major player in this space. They were a publicly traded company until relatively recently. They lost their ways. They stopped investing in R&D, and really that's the death wish in our industry. You have to continually bring out new product every couple of years to stay relevant. But they were one that was quite well known, probably got up to, I think, about $500 million in revenues, and was a darling on the stock market for a while, and until they lost their way. But those are some of the competitors that we see on a regular basis, and we tend to do quite well against them for a relatively small company, right? 22 people on board, all focused, or the majority focused on the technology itself. We punch well above our weight.
Got it. Thanks, Owen. Just thinking on sort of the competitive landscape, does it ever make sense to acquire one of these competitors, or inversely, how big do you have to be from a
yeah.
Well, yeah, how big do you have to be acquired, right? Like, where do you got to go? Do you acquire other companies, or do you eventually get acquired? How big do you have to be? What does that sort of look like from your lens?
Yeah. So when, to date, when we've been looking at M&A, is to fix a problem, right? Tariffs have been a major industry for us and others in our industry. And we bought a company in Pennsylvania that has supply chain capabilities and provides installation and service and support for IoT companies, not just us, but some of our partners and end users as well. They actually have a separate stream of business with UPS, completely outside of the work that we do with UPS. So really to date, and we've evaluated a series of other companies to determine how the best and most efficient way to deal with tariffs could be. And so that really has been the focus from M&A historically, but now we are looking a little bit more on the offense. We look for software companies that we can bring into the fold that can leverage our devices. A strategic complementary fit. And that might be in the bike share space. It might be in, remote asset tracking space. So, we're kind of moving from the defense more to the offense and looking at strategic acquisitions. In terms of getting taken out, I think we have a little bit more runway ahead of us. We'd like to, double from here, get it up to that $50 million revenue mark before we take a serious look at putting the company up. But right now, it's just focused on organic growth, some growth through acquisitions if the stars align, and if we get taken out at a point down the road, we're fine with that. Everything has to be focused on bringing value to the shareholders, and while it's not a focus for us, we're open to the discussions if it happens. Right now, we see growth. We see organic growth, and we want to capitalize on that.
Perfect. Thanks, Owen. I've got one or two more questions here. Just want to be respectful of the time, Adam. So you let me know if I should be stopping or if I should just keep going. But I'll just keep going. So I've got two more. Owen, you've been in this industry a very long time. Your last company was sold as well. Is there anything you're doing differently this time around? And the second piece of this is, Is there anything, like I'm a generalist, you're an industry expert. Is there something that we don't understand about this industry, or is there, a direction it's going that a generalist wouldn't be paying attention to?
Okay, so let me try and tackle that one first. The rate of innovation in wireless technology is happening faster now than it ever has. And so you have to be more selective, and you have to make sure technology that you focus on has a market opportunity and will drive growth for you. So, we're seeing that with the likes of AST Space Mobile. We're seeing that, historically with the launch of low power 5G. Now we're seeing RedCap and 6G opportunities come down the pipe. And, RedCap's an interesting one. It provides low power, low bandwidth when you don't need a lot of bandwidth. It operates at a low power level, but it also has the ability to do high bandwidth. And so, if you can think about the potential for a device that does video, LiDAR streaming, video streaming, audio streaming, and leveraging high bandwidth when it's needed, but sending, GPS coordinates that are relatively low bandwidth or sensor data that's relatively low bandwidth, and optimizing power when you don't need all of that. So, the key is to make sure as wireless innovation is happening more and more quickly, you need to really pick the technologies that will have the biggest impact into the market and ignore the technologies that either won't make it to commercialization or will not have as big an impact. So that's a challenge, right? The rate of pace of innovation is both an opportunity and a threat at the same time. So your other question, Trevor, just remind me really quickly. I'm sorry, man.
I was just wondering if you're like, given that you've bought, built and sold in the space before, it's kind of your second endeavor in the same, industry.
Yeah.
Is there anything you're doing different this time?
What was
Or any
different from the first?
Yeah.
I got it. Yeah. There's a lot, and we made our fair share of mistakes in the first go around. One that we're doing differently is we're selling through distribution. My last company had a large sales and marketing team. We were spending a lot of money on going to trade shows, on Google Ads, on putting advertisements out in online industry specific resources, and that's a costly approach. And so this time around, we've decided that we were going to focus on the technology. We were going to focus on distribution to bring our products to market and keep our overhead low. So, I think the strategy this time is in line with disrupting the market from a price point perspective. The strategy last time was, nobody was doing it, right? So you really couldn't, the distribution channels weren't there. I started my first vehicle tracking company in 1998. We had to bring in our own servers, our own generators, our own fiber lines and communication. We had our own pick and place machine. So, we were doing the whole soup to nuts. When we started this company, we leveraged AWS as our cloud provider. We leveraged distribution to bring our product to market. We just focused on the engineering, and that's allowed us to kind of keep a relatively small, lean team, keep our overhead low, which allows us to put the product into the market at a lower price, but still generate, positive EBITDA. So, plenty of lessons learned from my past that, I'm not looking to repeat those mistakes, going forward. One of those lessons, Trevor, was I sold my last company too soon. Right, I got it up from 0 to 25, 30 million in revenues, and I sold it out for 40 million. I could have easily held on to it for another couple of years and got more money out of it. So, when you ask me, are we for sale? No, we're definitely not for sale. I think we have a lot of runway, and we can make shareholders a lot happier by holding on and proving out that organic growth and a little bit of acquisition growth to get there.
Awesome. Thanks, Owen. If anybody's looking to find information about BeWhere, or how can they connect with you? How do they find you?
Our contact information is on our website. We do have chat on our website. So if you have a question, you can plug it right in there and that'll get to me. Otherwise, info@BeWhere.com or IR@BeWhere.com are two email addresses that you can reach out as well.
Awesome. And just turning it back over to Adam for closing remarks.
Thanks, Trevor. That was great. Thanks, Owen. Really appreciate it's a great place to wrap it up. Really appreciate your guys' time in doing this today. Thanks so much for all the color on the business and the great questions. We really appreciate it. As a reminder to the Microcap Club community, we'll have the recording up on YouTube as soon as it's available. And just want to say thank you again to Trevor and Owen. Really appreciate it.
Thanks, Adam. Thanks, Owen.
Thanks so much, Adam. Thanks.
Have a happy holidays, guys. Merry Christmas.
Happy holidays.
Take care. Happy holidays.
Yeah. Bye.